Welcome to the Loan Officer Training Series with the Mortgage Calculator. Today we're going to be talking about how to do a bank statement loan. Great topic, always something great to talk about. We'll get started here in just a moment. Let us go live on all the different platforms and then we will get into it. Thank you everybody for tuning in nice and early. Appreciate the comments that were already coming in there. As you tune in, drop a comment there, please. We appreciate it. And you can drop any questions you have as well in the chat as we go through the presentation here today. And it looks like we're live on all the different platforms and up and running, so we will go ahead and get it started. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, and I'm joined here by our sales manager, Jose Gonzalez. We are a correspondent lender specializing in non-QM loans, and what we do on this show every Tuesday and Wednesday evening at 7 p.m. Eastern is do a new training topic for loan officers. Today's topic is something we're very familiar with here at the Mortgage Calculator because we do specialize in non-QM loans and in self-employed borrowers. And what better loan program for self-employed borrowers than a bank statement loan program? So we do a lot of these loans. So I will let our sales manager, Jose, with 28 years of experience as a loan officer and a realtor and a lot of bank statement loans under his belt, I'll let him take it from here and get into the presentation. Go ahead, Jose.
Good evening, everybody. Thank you for joining us for tonight's great training on one of our favorite loan types, bank statement loans. Why is it one of my favorite loan types? Well, it's a beautiful thing when you're talking to that self-employed borrower. They provide their tax returns. You're looking at like negative $4,000 or $5,000 a month in income on a quote unquote traditional full doc option. But then since they are self-employed and we are at the Mortgage Calculator and we love providing solutions, especially to our outside the box borrowers, we then tell him that his monthly income is $33,000 per month using a bank statement loan option, and that they certainly qualify for that $1.4, $1.5 million property that they're looking to get with a low down payment. Depending on the loan amount, we can go as high as 90% LTV, aka 10% down payment, on our primary bank statement loan options. So, what exactly is a bank statement loan? Who qualifies for a bank statement loan? How do you calculate the income? Those are all things that we are going to cover now in talking about this amazing loan topic. Those of you that are only offering agency loan product options and maybe a HELOC, you're leaving so much money on the table. It's mind blowing, right? So that's why we love non-QM at the Mortgage Calculator. So let's break it down a little bit, right? I always love starting with the what is, right? Well, what is a bank statement loan, right? Well, let's break it down clinically and give some options here. A bank statement loan is a non-QM loan, always non-QM, never a conforming bank statement loan, or should I say agency. It's a non-QM loan which uses the borrower's bank statements to calculate the borrower's income, right? Not tax returns, bank statements, as part of the qualification process for the loan. So we got our traditional full doc, right? Using tax returns, pay stubs, W-2s, whatever is applicable in that traditional sense, using tax returns, pay stubs, W-2s, whatever is applicable for the borrower. And then we have our full doc, in this case for self-employed borrowers only, using bank statements as the income. We could also have full doc using profit and loss reports as income for self-employed borrowers. And then we have also asset utilization, which is not dependent on if they're self-employed or not, because it's not dependent on employment at all, right? Topic for another day. We just recently had that one. So the bank statements can be either from the last 12 months from application date. Then, depending on the closing date, if a month has elapsed, you're going to have to update the income. It can be either the last 12 months or the last 24 months. However, 12 months is preferred. I'll get into that a little bit later in the presentation why we prefer 12 months, but it's because you're basically take extending the review period. If you go 24 months, you're extending it out to 24 months. That means you have 12 more months where you could have a problem in your loan. So why do that for just an extra maybe quarter of a point in better pricing is usually what it is for 24 versus 12 months. The bank statements used can be either business, personal, or both. There are restrictions when you're using both, commingling, they call that commingling the accounts, then whatever is the expense factor that you're using for the business statement, which is usually the more restrictive one because personal is always 100%, is the one you're going to use. Now, banks, and I'll get into that more in the next couple slides down. Now, bank statement loans are for self-employed borrowers only. So the main borrower on a bank statement loan needs to be self-employed. You can add other income streams, but the main borrower needs to be self-employed uh, with a minimum 2 years in business. Could be different business of the same type. Started in one name, change it to another name, same business type, 2 years, that's acceptable too. Can be 1 year in business. You hear the 1 year self-employed? Well, can be 1 year in business, self-employed, if, for example, previously they were licensed in the same field as an employee, like an electrician or a nurse. Prime example, you got to have a license to be a nurse, you got to have a license to be a real electrician. You were doing it for a company as an employee, now you went on your own, and your own could be either a sole proprietor, could be an LLC, S corp, or C corp. Sole proprietor is going to file a Schedule C in the, but again, we're not doing tax returns here, but that's what a sole proprietor is. Um, Now, you can, like I was stating, combine W 2 or other income types from the same borrower or from co borrowers. Now, however, you're going to do that is guideline specific. And when I refer to guideline specific in this presentation or any other presentations, I'm referring to um, specific to the option that you're looking at for funding of this loan, right? That's going to have certain guidelines. So you have to review that and make sure that your loan conforms to all the guidelines for that specific option regarding when you're combining income types. For example, we have an option that you can combine. You can have a self-employed borrower that has a bank statement option because he has business A, has a P&L option for business B, has asset depletion, and is also W 2. I mean, this is a busy guy, right? But with all these jobs now, especially remote working, that's totally possible. That's already happened. So you could have those four income streams in one borrower with at least one of our options for bank statement loans. Now, not every option lets you combine all streams, so keep it, but that is a really cool option to consider that many of you would not even know is possible. And maybe you could be leaving money on the table. And you'll see that a little bit later. So again, our acceptable self-employed borrower entities, because this is for self-employed borrowers only, would be a sole proprietor, an LLC, an S corp, or a C corp. So let's get into talking a little bit about what program options are there that use bank statements as an income qualification method, because that's really what we're talking about here, right? One thing to note on all non-QM program options is remember that they all have guideline variations that are specific to that option, like I just mentioned. Guideline specific variations. Be on the lookout always for that. Remember, you as the MLO on non-QM loans are the automated underwriting search engine, right? You are the DU, you are the LP. You're going to filter everything according to the specifics of the scenario, and you're going to make sure you do a thorough job by uncovering every opportunity out there from every guideline that may be applicable. And at the Mortgage Calculator, we have a lot of guidelines that are always applicable. Note that third party verification of some type is always going to be required from, for that self-employed bar. We're really talking about self-employment verification, right? How long have they been self-employed? I just ran into this scenario in a loan where they conditioned me for the letter from the CPA, right? And CPA can be tax preparer, accountant, or an actual CPA. But luckily, the borrower had an LLC, so it was very easy. So in the slides a little bit down, you're going to find some issues and similar to this and how we can work around that. So, but then again, third party verification. Uh, the bank statement loans are offered in first and second mortgage. The second mortgage, basically the HE loan option for bank statements are possible. And max LTV for a purchase, 90% for owner occupied, 85% for investment properties. Max LTV for cash out refis, 85% for primary and 80% for investment properties. Max DTI is usually 50%, but you got to be on the lookout because in some cases there's additional restrictions depending on the LTV, depending on other factors like maybe first time home buyer or something like that, where it could reduce the DTI to 45 from 50, and in some cases you may be able to go higher. So look at the guidelines. Now on the business bank statement option, we have expense factors as low as 20%. Now, those of you out there think that the default expense factor is always 50%, but we actually have bank statement program options with a built in, included on the table expense factor as low as 20% if it's a service related business with zero employees. Like the guys running it themselves, like the one that I just had, he was running a short-term rental business, no employees. His debt was the property expenses, and the 20% expense factor was covering all of his marketing and overhead and all that kind of stuff you would figure for that, because his only expenses usually were minor repairs or the PITI on the property, which is already getting taken into consideration in his DTI. So that meant that I was able to use 80% of his deposits without having to get a CPA, quote unquote. CPA could be tax preparer, accountant, or CPA, without having to get the CPA letter to document the higher expense factor because he didn't have the CPA because the guy retired. Wow. So dodged the bullet on that one. Luckily, because I reviewed the guidelines and knew that it was going to work, but it took a lot of work and pushing, and then they accepted it, and we were able to close those two loans today. So, but as the bullet point says there, the CPA letter may be required for additional documentation of the expense factor if a high overhead or high employee business, is detected. So you may present it with one expense factor, but they may say, we're not sure. That type of business usually has a higher overhead, so we need a letter now from the tax preparer to document the expense factor. Now, they're not asking for an audited profit and loss or anything like that, but they're asking the tax preparer / CPA / accountant to write a business narrative, right? And how they document that expense factor, how they reach, like I did the tax returns for the last 3 years, and based on the number of employees of 2 and the limit overhead and the good business plan, yada, 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 the expense factor is 30%, for example, and then you get 70. But in this case, with this particular option that I closed, the table in their guidelines said 80%. So I knew that off the bat that I was going to get 80%. And that's what got me where I needed to be, because if it would have been 50%, that's substantially less income. I didn't have a CPA letter, so he wasn't going to qualify. So basically, this is one of the few options that he qualified for. And he also was one of the few options that actually had a 660 credit score requirement or above for 20% down slash 80% LTV bank statements. So it worked out beautifully. And like I mentioned there, some program options have expense factor tables based on business type and number of employees, like the one that I sought out and allowed my borrower to qualify. If using personal bank statements to qualify, you can use 100% of business deposits. So they may question copy of the item or the contract or the invoice to prove that it was actually a business related deposit. Be ready to document those. Definitely any deposit 50% or more or greater than the monthly income calculated on the loan will require documentation of the deposit, like the item, letter of explanation, or an invoice, letter of explanation, contract, letter of explanation, both. One, not one or the other. Letter of explanation plus supporting document for the item. And like I mentioned before, you can combine business and personal bank statements. They call that commingling, but in that case, the expense factor used will be that was established for the business bank statement, which is always more restrictive because personal allows 100 if you're only using personal, but if you're using business and personal combined, and you are using 60% for the business, then you're going to use 60% for the personal as well. So we've touched on a few of these already, but what are the potential issues that you can face in your bank statement loan? Now, it's so important for you to understand this because this is what you're going to be explaining to your borrower as you empower your borrower with all of this great knowledge, wealth of information, so that your borrower can fully understand, comprehend what's going on. Because everything, remember, risk is relative to rate, so they can't be thinking they're going to get a conforming loan rate with a non-conforming loan. Doesn't work that way. Now we can get close, as you've seen if you were looking at today's daily rates that we did, the podcast we do every morning at 11 a.m. Eastern Standard Time. The bank statement investment loans were beating by a lot, by over a point in cost, the agency investment loans. Oh, I mean, it was not even close. So be on the lookout for that when people think agency is their best option. Now, what are some of the potential issues for this? Well, let's touch on some bullet points here. One potential issue in your bank statement loan as you're interviewing the customer, remember, you find out, or as you're reviewing documentation, that the customer cannot document the needed business history. This would be probably one you'd find out when you're doing the initial review, the phone call, and you're asking them how long they've been in business, what type of business, what if they have, if they're an entity, if they have a business license, all these things that could prove self-employment. Because if they don't have the tax preparer letter, they got to find one. If that, and they're like a sole proprietor, it's going to be very hard. And they don't have any licenses or anything. How are you going to prove self-employment? Right? Which is what I'm stating. If they don't have a CPA and none of the above docs are available and they do not have a business license, then how are you going to document self-employment? Right? So basically, another potential issue. Now, I was able to resolve it, remember, because my guy did have an entity and I was able to get corporate docs and website verification for my borrower. So another issue is declining deposit trends or closing the month with a low or negative balance. Right. That's an issue. Now, sometimes they can show that the money was being transferred to another account that they didn't provide. Closing with negative balances could be a real killer. Closing with low balances, not necessarily if they were transferring a chunk of money out to another account that they use as an operating account. So then they may have to provide that just to show where that money's going. So they could show that they actually have money. Remember, that does happen. So you may have to explain it. But if the real reason is that they just every month they're getting tapped out, then the expense factor may not really be what it is. And you may have to then provide the customer may have to provide a profit and loss plus the business narrative from the tax preparer to accept that. You're going to have some obstacles in your deal. Now, there's a workaround for that, which I'm going to cover now in a minute. So large deposits that cannot be documented as business related income, that one usually only you're going to find out once you're reviewing the bank statements. And you're asking them, hey, you got this deposit for 80,000, you got that deposit for 100,000, you got that deposit for 120. Is there an invoice? Is there a contract? Is there a copy of the item? And they start telling you, well, that's some deposit I get from this collaboration that I do out of, like some weird country, and it's going to be tough because they don't really provide any contracts and there's really no invoices. They just send me $200,000. That's an actual deal, by the way. An MLO had of ours. The guy had got like 4 deposits in the whole year, 200, 200, 200, and 250. And she was trying to do a bank statement loan. And I said, unless he can document it, this is going to be a profit and loss, which is the usual workaround for bank statement loan options. But problem with the P&L loans is that most will require you to provide also the last 2 or 3 months business bank statements to document the income stream. So if the issues were in the last 3 months, you're going to have problems. There may be an option that doesn't require business bank statements. You got to search far and deep, but I'm going to tell you the trend is that they ask for the last 2 or 3 months business bank statements. So make sure any of these issues, like the declined deposits, large deposits, can be documented. Irregular deposit trends, also months with low or no deposits, showing maybe a drying up business. NSFs and overdrafts. Make sure none of that's going on in the last 3 months if you're going to do a P&L. But for the bank statement loans, we do have an option that will allow the overdrafts with an explanation, but you can count on most of the options. Pretty much 99% of the options will have an issue if the borrower has 3 or more overdrafts in the last 12-month period, overdrafts or NSFs. Beware of an underwriter increasing the expense ratio, in other words, reducing your profit margin due to the business type or overhead that they perceive. In other words, they're going to look at the bank statements every month, and if they see a higher outgoing expense on the account than what is represented in the expense factor, and it's not going to another account of the borrower's where he parks his money, you're going to have the underwriter adjust the expense factor. The borrower now may not qualify unless you get additional documentation, like I just mentioned, a P&L and a business narrative from the accountant. Like I was just saying, because then they may request a P&L report due to specific guideline requirements. Now, some bank statement loans ask for a P&L included in the guidelines. So look deep in the guidelines and make sure that whatever bank statement option you're selecting or the borrower selecting does not automatically ask you, or the borrower, should I say, to provide a P&L. Because some do, most do not. So people assume that the program does not require a P&L, but some do. Don't get caught off guard. So make sure that you are thorough in your guideline review. Like I mentioned there, this is a guideline-specific requirement, so please be thorough. So calculating income, right? This is where it gets interesting. Make sure that you complete whatever business narrative form, and the borrower usually has to complete it and sign it as may be applicable per the option guidelines, and this will usually determine the acceptable expense factor and profit margin to be input in the income calculator. That's a mouthful, right? And I'm going to show you what I mean right here. Boom. Now, this is a generic bank statement income calculator that I use. I removed the specific branding here because I like to use it. This is the expense factor default at 50%. And then this is where we can adjust it to whatever it is that we have. So if I want to put expense ratio of 20, that means it's going to be 80% of the deposits. Then it's going to give me the averages there, right? 12 months. So there you go. Versus the 12-month average at 50% default is 40,000. So this same borrower qualifies for a lot more because now we're at 53,090.82 instead of 40,839. And these are actual numbers on the deal, on a deal there. So that's what we're talking about when you're inputting the accurate information here so that you can get then the accurate deal. And then basically in this particular form, and it may be different in some other forms, but in this particular form, you list here the month of the statement, or should I say the bank of the statement, right? And this is just a month one, two, three, four, five. So however many you have here. Now I didn't have more, but I had more statements per month, doubling up in some cases is what we had. And then here's where you list the gross deposits on this column. This is the month, gross deposits, and then over here you start listing in a minus every deposit that's not applicable that you are reducing from the gross deposits, and then way in the right over here, then it gives you your net total deposits here, and then down here is your total deposits for the year divided by 12 months, and then it gives you the month, the averages here, right? And then this is for business bank statements, and then this would be for if it was personal bank statements, and then all that kind of stuff. So that's how how we do it here. Now, one thing to note is that you want to hold on a second. You want to make sure that you can utilize any of the resources available, like bank statement review by the conduits, where you either upload the last 12 months to a specific uh, portal, and then they will complete the spreadsheet for you. They will calculate the income for you, doing the removals of what they consider deposits that they're not going to use, and then give you an income. And in many cases, they even back up that income uh, with underwriting. So they will get and tell you, okay, this is your income. And that's what the underwriter is going to look at, unless there's something glaringly wrong when they're reviewing the whole file. You know, that's what they're going to use 99% of the time. There could be some programs that do that, and they'll tell you this is just a convenience for you. The underwriter's still going to have to review the file. This could change. So you always want to double check their calculations. But in showing you that document there, we were talking about inputting to the deposit. Then again, be aware of the expense factor restrictions according to whatever table is out there. So you put the correct expense factor. Make sure you compensate for the proportionate share of the business. If the borrower owns less than 100% of the business, right? That you added in there as well on the form. If it's 100, you leave it alone. If it's less than that, you start putting a number in there, and the worksheet will calculate. The borrower needs to be at least, for most of the bank statement options out there, at least 25% owner, because that's self-employment plateau, right? 25 or more when you're looking at these S corps, because that's the only time you can do this, not with a C corp. Use banks unless they own 100% of the company when it's a C corp. That's a different story. But use the bank statement review service when possible. Like I mentioned, double check the calculations and confirm with the investor regarding income guarantee. Now, this is when I was talking about earlier about do not leave money on the table, right? Provide multiple options. And why do I say this? This is just in general, not just multiple bank statement options, not just variations to your bank statement options, multiple loan options. The two loans that I just closed that I was referencing, that I had some issues with and resolved it, that borrower originally was responding to a DSCR loan, right? He responded to the DSCR loan. We did some DSCR quotes for him, but his credit was lower than he thought. He thought he had like above a 680. When we did the pull, it was a 675. We tried to rescore, it didn't work. Still was in the 670s. But a bank statement option went as low as a 660 at an 80% LTV, which is what he wanted. and he really wasn't rate sensitive. He was LTV sensitive. He knows his credit score is going to go up, and he can always refi a year plus down the road. I always recommend that they have to wait a year before they do any kind of a move like that. Strongly recommend it. Uh, so he was fine with the rate, a little bit higher, but he was getting a good deal on the property. He just wanted to close on the deal. He deposited about a lot every month, 120, 130 every month. So definitely was a great bank statement option. He just thought the DSCR was going to be less complicated, but obviously the credit restrictions were a little bit tighter. So that was the solution we provided with the bank statement loan. Now, that one ran into a little issue. Now, this is really a nice, interesting story how this happened, how it worked out. That one ran into an interesting issue. That loan came about at the last minute, so we did not have the time to present it to the bank statement review of that conduit to make sure there were, what's my income and make sure there's no issues. Had that been done, we would have known that the conduit was going to have an issue with the format of the bank statement. Nothing wrong with the deposit trends or nothing. Their software that they just employed, very proud of it, allowed them to operate at a better scale, right? They were scaling up, so they got this great software. However, the software could not read properly the format of the statements that the borrower provided because it was a tech driven bank, online only bank, and they just had a different format. So the workaround for that was that I had to hound the conduit for a proper format on an Excel spreadsheet so that I could then, which is what I had to end up doing, document each and every business related deposit that borrower had for the last 12 months on 3 accounts. Wow, it was a lot of work because this borrower has 6 short-term rental properties, gets multitudes of deposits all over. It was like, I don't know, 60, 70 deposits, at least 80 deposits a month or more. It was crazy, and it was 12 months worth of that documented on a spreadsheet, each transaction, so that then they could then, I guess, calculate it that way. And that's what was done. I wasn't going to be deterred by the challenge, and I did it. It took a few days to get it right and get them to give me the format and all that kind of stuff. But it's not like we had too many other options to send the loan with the credit score that it had. So it was basically make it happen, sink or swim. And I didn't want to sink, so I made sure that the loan closed. So with that being said, provide multiple options. Do not leave money on the table. And in reference to, not only do you want to provide multiple loan options, right, as applicable for the borrower type and your license, right? You don't want to be sending loan quotes if a license is required for a particular state that you're not licensed in. So make sure you offer 1, 3, and 5 year prepay on investment properties. Make sure if it's a 12 or 24-month bank statement is being considered, the 12-month option is usually preferred because it gives less issues with deposit trends and other potential issues. Make sure the borrower knows that. If you empower them with that information, it'll be a lot easier for you when you're structuring the deal and trying to, get the application finalized, get it presented to underwriter, and get it closing. Everything starts with the borrower understanding the why, what's going on, so they can understand the risk involved and the cost and the rate and everything else, so that when it comes time for them to see the paper and sign the LE, they're not going to say, oh, what is this? They're going to understand what's going on. You empowered them with all the information they need to review everything you have in front of their face that they're going to sign gladly because you took the time as the amazing loan consultant that you were trained to be by the mortgage calculator to explain everything properly and empower the borrower. So vary the LTVs to show the difference in cost, right? This is so important here. Rate should not be the only factor when you're discussing the non-QM alt-doc loans with your borrowers. There's a lot of factors being taken into consideration, like the fact that they don't want to pay, usually they don't want to be forced to file high income if they don't have to just to qualify for a loan that results in higher tax liabilities. Um, there could be other reasons in the guideline that would be specific to that borrower's needs. So rate is not the only factor. What is specific to that borrower's needs, to the profile of that loan, that is going to require possibly a specific guideline option that may not be the lowest rate, but it's going to be the one that's going to close the loan of all the bank statement option loans. You've determined he has to go bank statement, but which is the one you're going to use? For example, mine was not only the fact that it, due to credit score, was one of the only ones, but the one that I closed with allowed my borrower that did not have a tax preparer to close the loan with an 80% profit margin of his bank deposits and qualify for the loan and close it. So that was very guideline specific. And definitely rate was not the factor that was being considered there in that situation. And then beware of additional documentation requirements on the different options, as some, like I mentioned, requiring a P&L, others requiring the CPA letter as the only method to verify self-employment, and third-party verification being like an absolute requirement. And like I always mention, the profit and loss option is a great workaround if having issues with large undocumented deposits, declining income trends, or NSFs, but be on the lookout for having to provide the last 3 months business bank statements. And last but not least, I wanted to provide you here with just a sample quote, whet your appetite on what's possible on a $500,000 purchase on a primary property, which would allow you to go up to a maximum 90% LTV, 10% down, using 12 months bank statements, either business or personal is the same rate, with a 760 credit score on a 1-unit property. So we're looking at lowest cost option here, 1.9.625% rate. But check this out. You can buy it all the way down to 8.375. No mortgage insurance, 90% LTV, costing 2.375 points. And if the seller is paying some seller credit, you can buy this even more without having any issues with your compliance test on your points and fees, because this here primary is gonna go with the 3% TRID usually, unless we have some options, maybe let us go 5. So hopefully I was able to clearly explain and define a lot of the ins and outs on the bank statement loans, so that you all can make some more connections when you're interviewing your borrower. Remember, last night we talked about the call, right? And what you have to achieve. This is one of the paths that call could go on when you start talking about bank statement loans, right? And self-employed borrowers, you'll start talking about bank statement loans as a potential option, as a great option, especially if it's an investment property going to 80% LTV and they're self-employed. Man, that's a great option. It beats conventional rates that are full doc at 80%. Just keep that in mind. So let's see if there. I don't see any questions. I hope that means that everybody really totally understood the point here. As you all know, this recording will be available pretty soon after it's done, so you can always go back to it and reference it as a guide. And for our team, we do have those PowerPoints always available that we can share with you as well. All right, so I don't see any additional questions, so I guess we can probably wrap it up, Kyle.
Yeah, I think we are good. Okay, cool. All right, well, thank you everybody for tuning in. Remember, we do this Tuesdays and Wednesdays, 7 p.m. Eastern time. So we'll be back next week with some new topics. We'll see you Tuesday, 7 p.m. Eastern for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great night, everyone.